This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, up until now, when dealing with companies and the preparation of a corporation tax computation, we've only had to deal with a single company. Now we know the contents of that corporate tax computation, but what happens when we've got to deal with a group of companies? Now you'll probably be familiar with groups from your financial reporting and financial accounting exercises there. You may also be familiar with the idea that in corporate reporting we have consolidated accounts. Well, don't panic at this particular point in time, because there is no taxation equivalent of what we do in consolidation in financial reporting. What we have is that every company, whether a single company or in a group of companies, every company has its own individual corporation tax computation. But there will be implications felt by companies that exist within a group structure. Now, those implications will be a combination of two things. There are, in certain areas, rules and regulations that stipulate the group relationships and the issues that pertain to them. But then against that, there are also claims and elections available to group companies, depending on the precise group structure, which may therefore improve the situation so far as the companies are concerned. So for every company, we will produce its own corporation tax computation. But when we define groups, we define them in terms of two percentage levels, which, as you'll see here in our introduction to Chapter 22, are defined by membership of either a 51% group, or, when it gets rather more interesting, when we step it up to 75% groups. And we've got a list of issues that we need to deal with. Now, so far as related 51% group companies are concerned, we were introduced to those back at our introduction to corporation tax, when we saw that we would have a profit limit of 1.5 million for an individual single company. And that profit limit would determine whether or not the company was large. And the context of being large has no effect these days in terms of corporate tax rates. There's only one, 20%. But where it does have an effect is when you pay your tax. And you may recall, I hope you do, we'll be reminding you of that very shortly. But if you are a large company, then you may be required to make quarterly instalment payments rather than merely making payments of your corporation tax 9 months and 1 day after the end of the accounting period. But that profit limit of 1.5 million exists for a single company that has a 12-month chargeable accounting period. If you are in a group and there are therefore related 51% group companies, then that profit limit must be divided by the number of related 51% group companies that exist for each of the companies within the group. So there, bad news, as it were, being a member of a group, because if we have a reduction in the profit limits, then there is a greater chance that a company is going to have to make quarterly instalment payments. And very obviously, we don't want to do that. We don't want to be paying that tax sooner than we have to. So bad news there. What we'll also see is another rule and regulation that applies is about, in capital allowances, the availability of our AIA, where what will happen is, again, there will be one AIA for the entire group. Now, having said that, one AIA for the entire group, what the group may do is to choose where to apply the AIA. Now, we know that we're looking at an AIA level these days of £200,000 based on a 12-month accounting period. So if within the group you had more than £200,000 of qualifying expenditure, you get to decide where you would want that. Now, in the same way as when we looked at losses, corporation tax losses, in our earlier chapter, we could see that objectives that we may have to get the best use out of those losses would be to avoid for companies having to make, yet again, those quarterly instalment payments. Think what losses do, think what capital allowances do. They will reduce the profits of the company. So if we had a company whose profits prior to the deduction of any capital allowance was above the profit limit, by allocating more of the AIA to it out of the £200,000 available to the group, may allow you to bring that company, like a loss would reduce its profits, so too would capital allowances reduce its profits, specifically trading income. But if we could bring that down below the profit limit, that would avoid for at least one more year the requirement to make those quarterly instalment payments. So again, there will be logic about how and where we apply the available AIA, but one AIA split between the group members. We then got, in terms of the 51% group relationships, good news, an election, a claim that is available for companies to go into a group VAT registration. Now, the details of that, as you can see there, are to be found in our last technical chapter as such, in terms of taxes, and that's chapter 25. But it's a simple enough concept. If you have got lots of companies within the group and their taxable supplies require them to be VAT registered, then without any group VAT registration, each company would have to be individually VAT registered, accounting for its own input and output tax. And if there were intra-group transactions, where a standard rated supply was made by one group member to another, then output tax would have to be charged on the sale, and the buying company would seek to recover the input tax. Now, if we wish, we can choose which of our 51% group companies will go into a group VAT registration. And what it means is, rather than each individual company preparing its own individual VAT return, guess what? We can produce one group VAT return for those companies within the group VAT registration. But there's a decision to be made there. You get to choose which ones go in, which companies that is, go into the group VAT registration and which stay out. Well, in chapter 25, when we deal with that, we'll look at decision making, at how we might decide which companies to leave out. Because on the face of it, it would seem like a good idea. If we've only got one VAT return to do rather than several, administratively, that seems like a good idea. It would also have the added advantage that when you had that intra-group supply, that the seller, the supplier, would not have to charge output tax and the buyer would not have to seek to recover input tax, that intra-group transactions would be outside the scope of VAT. So in that 51% groups listing there, we've got a couple of rules that apply that are going to be restrictive in terms of reducing the profit limit with the related 51% group companies, limiting the AIA in terms of capital allowances, but then a choice factor of which companies to bring into or leave out of any group VAT registration. But things do get rather more interesting, and hence most questions, therefore, specifically on groups, would deal with these two areas. Dealing with, firstly, group relief of losses. Now, again, you are familiar with, and if you have forgotten, I would strongly suggest, before we move on to look at 75% groups and specifically group relief of losses, that you go back and remind yourself of the basic loss reliefs for a single company. That if a company were to incur a trading loss, that would give a nil trading income assessment. And then what could we do with that loss? Very simple. You could use it in the current period. You could carry back, usually for 12 months, other than in a terminal loss situation when it was a 36-month carry back from the beginning of the period of loss. So current period, carry back, or otherwise carry forward. You then only have to remember, in each of those circumstances, what do you set the loss off against? And in both current period claims and carry back claim, or claims, as the case may be, the loss goes against total profits. Remind yourself on the corporate tax computation where total profits lies. It was, of course, before the deduction of any qualifying charitable donations that would then be deducted to derive a bottom line TTP. With carry forward, it was more restrictive. It will go against future trading profits and only trading profits of the same trade. Well, now we get introduced to a much more flexible concept, group relief of losses, such that once we have established which companies are in the relevant 75% group for purposes of group relief, then any amount of a trading loss, or indeed NTLR loss, but trading losses are for us at this level, any amount of a trading loss may be set off against any amount of the claimant company's TTP. So unlike with the single company reliefs, there is flexibility. You can make partial claims. Wasn't an option with those other single company reliefs. If you claimed against total profits, then all of the loss would be used against all of the total profit. You could not leave just sufficient of that profit to cover, for example, your qualifying charitable donations. Not an option. You either claimed it or you didn't. And when you carried forward, you didn't even have that option. It will go against the next available future trading profit. Well, now, once we have again defined who may group relieve with whom, then any amount of a trading loss may be group relieved against any amount of a claimant company's TTP of a corresponding accounting period, meaning that one company's loss within a group may be split between any other relevant 75% group members. Now again, going back to the point we made a few moments ago, how do we get the best use out of our losses? Well, one issue, of course, was to try to ensure that companies did not have to make quarterly instalment payments. Always a bigger risk within a group when, depending on, as we've seen, the number of related 51% group companies, you are dividing out that profit limit. You are reducing it, and therefore making it ever more likely that any individual company will be pushed into the large category and therefore have to make quarterly instalment payments. What do losses do? As we said when discussing capital allowances, they reduce profits. If therefore we can apply the losses where they would bring companies down out of being large to under the profit limit, then that avoids quarterly instalment payments being made. Another bonus for us in terms of elections available, good things available to group members, is gains group membership. Now again there, we will see that there's a combination of rules that apply for any intra-group transactions. When one gains group member transfers an asset to another, it has to be done in a specific way for taxation purposes. But then also elections and claims that are available. Now there's two such elections. One very simple one that we should be able to understand even at this point without looking at the detailed note is that we have available group rollover relief. Now remind yourself of what you saw, well, not that long ago in the previous chapter on rollover relief. What happened? There it was a company disposing of a qualifying business asset and then within the relevant time scale reinvesting the proceeds in another qualifying business asset, allowing rollover relief to apply. Well, the concept of group rollover relief is a very simple one. It is that one gains group member does the selling of a qualifying business asset and makes the gain, and then that gain can be rolled over against the base cost of a different gains group member that has gone out and purchased a qualifying business asset within that relevant time scale of 12 months before to 3 years after the date of disposal. So our rules with groups is a combination of restrictions as regards you will do this way and it will have these consequences, and then notably, most specifically with 75% groups, the ability to get group relief of losses and also membership of a gains group, allowing therefore a better situation as regards the use of capital losses against capital gains and also the ability to have group rollover relief. So, time now to look at the details of each of those areas. Firstly, something we do know something about from earlier studies, related 51% group companies. Now then, we know that this is not a good thing, that the more related 51% group companies a company has, then the lower will be its profit limit, and the lower its profit limit, the greater the prospect of having to make quarterly instalment payments to settle the company's corporation tax liability. Not good news. So how do we define them? Well, as we can see here, companies are related 51% group companies if one company is a 51% subsidiary of the other, or they are 51% subsidiaries of another company. A company is a related 51% group company if the parent company owns directly or indirectly more than 50% of the share capital of the subsidiary company when at the end of the previous chargeable accounting periods. For this purpose, dormant companies are excluded, but overseas companies, even though they will not themselves be subject to UK corporate tax on their overseas profits, they are included there. So we need to look at, for determining the profit limit for each group company within our group for the current accounting period, how many related 51% group companies were there at the end of the previous chargeable accounting period. As we know, the implications are that our profit limit of 1.5 million for a single company, used to determine whether the company is large and therefore required to make quarterly instalment payments, that is now to be divided between the number of related 51% group companies. Now then, this can get just a little bit more interesting in terms of what will be the profit limit for each group member when we look not just at a group where there are direct subsidiaries, but also where there are indirect subsidiaries. That does make life a whole lot more interesting, shall we say. So, here is a little group structure, or most of it at least, that I prepared earlier. So we're dealing with, for the Villa group of companies, the accounting year ended 31st of March 17. Now, Villa to begin with has got two direct subsidiaries, as you can see there, and do note down in your own books there. We've got Villa owns 90% of company A and 80% of company V. Now, very clearly, therefore, Villa A and V are related 51% group companies. But what now is the relationship of A to its, as it will be, subsidiary company F, and V to C? Well, I'll tell you here that A owns 80% of F and V owns 60% of C. Now, in relation to our related 51% group companies, what we've done now by having indirect subs is to make it a whole lot more interesting in terms of determining the profit limits for each of these companies. As we will see, Villa is related to A and V, obviously, because the direct link there is 90% and 80% respectively. Villa is also a related 51% group, in a related 51% group relationship with company F. Why? Because 90%, as we have there, of 80% is an effective 72%. Therefore, going back to the point that we had in our notes, let's just return to that. It says that we have got the company owns directly or indirectly more than 50% of the share capital. So looking at the link from the principal parent company, Villa, down to F, does Villa indirectly own more than 50%? Yes, it does at 72. So looking at that at the moment, all four of those companies are related 51% group companies, therefore requiring the profit limit for each at this point to be divided by 4. But Villa, A, V, we've got direct and then down to F indirect 51% group relationships. So they're all related 51% group companies. The interesting issue arises with the relationship from V to C, 60%. Now that is more than 50%. But the problem so far as Villa is concerned is that 80% of 60% is an effective 48%. So company C is not a related 51% group company of Villa. It is, however, a related 51% group company of its parent company V, which now means that we've got differing numbers of related 51% group companies for the different members of the group. Let's have a little look at them and who we've got. Right, Villa is related to A, to V, to F. So far as Villa is concerned, there are 4 related 51% group companies. Villa is not related to its sub-subsidiary company C. And the same will apply with A and F. A and F are a part of the Villa group here. They are therefore linked also to Villa through the to V rather, through the 80% shareholding that Villa has in company V, but not to company C. So for Villa, oops, let's see if we can get this written down. There we go. For Villa, company A and company F, they are in a group also with company V, which equals 4 related 51% group companies. 4 related 51% group, well, yes, companies there, not groups. Let's just put that group companies there. Now then, what makes this, as I say, even more interesting is company V is related not just to Villa, to A and to F, but it is also related to its own 51% plus subsidiary, company C. So for Villa, for A, for F, there are 4 related 51% group companies, which equals therefore profit limit for each 1.5 million divided by 4 is £375,000, I think. But for company V, we've got 5 related 51% group companies. Why 5? V is related with Villa, A and F, that is 4 of them, plus V is related to its own direct 51% subsidiary, company C, so it's got 5. Therefore, for it, company V, its profit limit will equal 1.5 million divided by 5, and that therefore will be £300,000. And if that wasn't interesting enough, what about company C? It is only related to its parent company, company V. It's not related back to the principal parent company Villa, and through Villa, therefore, to companies A and F. So far as company C is concerned, there are how many related 51% group companies? There is it, company C, and its parent, company V. Therefore, there are 2 related 51% group companies, which means its profit limit, 1.5 million divided by 2, equals 750,000. So there you go. 5 companies exist within the Villa group. Villa's direct subsidiaries, A and V, and its indirect subsidiaries, F and C. What causes the problem, and therefore the differential in terms of profit limits, to be used in the various companies' corporation tax computations in determining are they large or are they not, is the fact that the relationship from Villa down to their company C is only an effective 48%. We don't have effective 51. However, V does have effective 51 with company C, hence 5 related 51% group companies so far as V is concerned. It is related to all the other members of the Villa group. And C, down there on its own, only related to its principal, its parent company, company V there. So we end up that when doing the corporate tax computations for Villa, A and F, we have to use profit limits of 375,000 based on the fact that they are within a related 51% group of 4 companies, themselves along with company V. Company V, on the other hand, is also related to its company, its direct subsidiary, company C, so it's got 5 related 51% group companies. Therefore, it, company V alone, will have a £300,000 profit limit. And finally, company C only has 1 related 51% group company related to it, its parent company V, so there are 2 related 51% group companies, therefore £750,000 of profit limit. That makes it a whole lot more interesting relationship so far as related 51% group companies are concerned. Clearly, if you had only direct subsidiaries, you're not going to get this differential. All of the companies will have the same profit limit. But where we have indirect subs and we fail on 1 or more, the effective 51% test, you're going to end up with different profit limits for different group members for the accounting period. The other issues to be aware of would be that those relationships will only be that if they were all in that group structure as at the end of the previous period. So as this is the year ended 31st of March 17, that relationship that we see there on the diagram has to have been in existence at the 31st of March 16, the end of the previous accounting period. If we had bought, for example, company C part way through the accounting period, then it would not be related with the Villa Group, therefore not with V, for this accounting period. It would only be related with company V in the next accounting period. So we do not include, in determining the profit limit to use for our group companies this period, we do not include the companies that were acquired part way through the current accounting period. We will include those companies that were sold off part way through the accounting period because they would have been within that group at the end of the previous chargeable accounting period. So that's our relevant date, the end of the previous chargeable accounting period. Okay, let's go back to our notes. Again, make sure that we've understood it. Who are we related to in the context of related 51% group companies? If the parent company owns directly or indirectly more than 50% of the share capital. So when we've got indirect relationships, if we're going to have the principal parent company, Villa in our group, and company C as related 51% group members of the same group, the effective relationship between them has to be a minimum, well, more than 50%, we'll call that 51. Okay, now you've got a very much more simple example there, example 1, for you to have a go at. So have a little go at that, establish your answer to it, review that in the back, and then come back to me, but just pause at this point in time. Okay, well, hopefully as you have now checked it out, we've got A Limited owning 100% of the share capital of V, F and C. So it's all direct relationships. There are 4 companies there that are related 51% group companies. So dividing 1.5 billion by 4, would have given you a revised profit limit of, as you would know, £375,000. If the TTP is therefore 400,000, then for this accounting period, the company is indeed large. We do make the point that although I've given there the taxable total profit, what it is that we compare with the profit limit is the augmented profit. And the augmented profit is your TTP plus any dividends received from non-subsidiary companies. Any dividends received from non-subsidiary companies. We do not include, in deriving augmented profit, we do not include dividends from subsidiary companies. They are ignored. Dividend income from a subsidiary isn't just exempt, it does not also go in determining augmented profit that may impact, therefore, on the size of the company. So here, if the company A Limited, as we had, if it had a TTP of 350,000, so just below 375, it may still be large if we were talking about any dividend income in excess of £25,000, which raised its augmented profit above its revised profit limit of 375. So it's augmented profit that we compare with that profit limit. Okay. Just on these 51% group relationships, as we said, we'll look at the group VAT registration in Chapter 25, but understand, for purposes of group VAT registration, we are talking about where indirect subsidiaries exist, a different rule to that which we applied so far as related 51% group companies are concerned, such that as long as each direct link between a parent and a subsidiary, as long as each direct link is more than 50%, then group VAT registration is available. So when we saw our relationship of Villa to A to F, from Villa to V to C, this relationship here is 80% more than 50. This relationship from V to C is more than 50. So company C would be included within the eligibility for group VAT registration. So we've got a different rule when we look at group VAT registration. All we've got to do is to look at direct links to establish that group structure. So there, Villa owns 80% of V, V owns 60% of C. Each direct link is more than 50, so those companies are entitled to be in a group VAT registration. The other issue for 51% groups, availability of AIA, then again it's just a basic group relationship that needs to exist, the same as we've just explained with group VAT registration. So all 5 companies in the Villa group, Villa, A, V, F and C, all 5 of them therefore would be in a group, and therefore only one AIA would exist for all of those companies. That would be £200,000 to be divided there, in our Villa Group example, between the 5 companies within the overall Villa Group of companies. How you split it was up to you, and again, the logic, same logic as we demonstrated in terms of loss reliefs. You'd be looking to reduce profits down out of the large company status by reducing the profits down below the revised profit limit for each company in question. So as long as they had qualifying expenditure, you get to decide within the group how much of your available 200,000 AIA would go to each such company. That therefore means that, having dealt with 51% group relationships, we will then be able to move on, not now, but in our next session together, to look at the big ones, the big relationships, 75% groups, specifically next time, group relief of losses, probably the single most important area so far as groups are concerned. We look forward, therefore, to telling you all about group relief in our next session together.